Hello, I'm David Bluto, here with my business partner Darren Casely to continue our look at responsible investing. Sustainability is on everyone's mind these days, everything from the wider adoption of solar power to bringing your own bags to grocery stores. Many investors want their investments to follow the same principles. We're joined by Tom Weil with NEI Investments. NEI is a global leader in responsible investing, and we're happy to have Tom answer questions about this topic.
In the previous segment, Tom introduced us to responsible investing. And Tom, you touched on the idea of screening or excluding positions from an investment portfolio. Now, we all have very different ideas on what may be right and what may be wrong for society. And investors may certainly understand the values-based reason for responsible investing. But is there a performance difference?
Yeah, it's a good question. And it's a fallacy that's followed us around from the very beginning where we started this movement. Categorically, it is incorrect. And there have been numerous studies, and particularly it's really sort of these studies have accelerated in the last few years. Harvard has a seminal study, BlackRock, Deutsche Asset Management out of Germany, and Morningstar here in Canada, the mutual fund sort of overseer. And they've all said the same thing, that ESG or responsible investing tends to outperform in the long term. Now, when you dig down into these studies, what you'll see is on the upside of performance, most of what I have read is that the performance is basically the same as your average investment, maybe slightly better. But it's on the downside is where you really see the difference. And it only makes sense. If your goal is to take investments out or avoid investments that have certain environmental, social, or governance risks, which can heavily negatively impact stock price, if you avoid those, you should outperform, particularly on the downside.
Do you have any idea what your average investor is looking for, or the attributes of your average investor?
Yeah, and they are different. Certainly they're different from a values perspective, but they're also more durable, typically. You think about, and there's lots of studies, we've all seen them on this, on market peaks and lows. Mm-hmm. And the average investor, if they don't have guidance from good advisors, tend to jump into the market at its peak when they're at the peak of risk as well, and jump out of the market at the trough when really it's at the point of largest opportunity. What we have found about the average responsible investor is that they see their investments in a more holistic fashion. It's about the numbers, but it's also about the change that they're affecting. So they tend to sail through these market peaks and troughs a little better than the average investor.
So it ties in really with it's really time in the market versus trying to time the market.
Exactly.
Yeah. Thank you, Tom. We'll continue to share more information from this series. For more information and to see more videos, please visit our website at bdcwealth.ca or follow us on Twitter at bdcwealth. Thank you and take care.